If you've been told that you might want to look into a USDA mortgage, then you're in the right place. My name's Scott Hastings. I'm a loan officer based in Charlotte, North Carolina. And today I want to talk to you about USDA mortgages. So I did a video a couple years back, probably 4 years back. It's still here on the channel. And it was pretty popular about USDA loans. And I wanted to do an updated version for 2023. So I just want to talk about what are USDA loans, who can qualify for them, what those qualifications are, and really some myths that I wanted to dispel about USDA mortgages. You might see videos on other channels. And I just want to tell you from a loan officer's and mortgage broker's perspective, really doing USDA loans, what does it really take to get qualified? So first, a USDA mortgage is a mortgage that is, like you probably heard, 100% financing. So if the home you want to buy is $300,000 and you qualify, you will get a mortgage for $300,000 and you won't have to put any money down. Now, you will be, like any loan, you will be responsible for paying any closing costs that are involved. So the attorney's fees, the appraisal, the title insurance, setting up an escrow account so your taxes and insurance can be paid, or that are included in your mortgage payment will be collected and kept in an escrow account each month. You have to pay a year's worth of homeowner's insurance up front plus a 3-month cushion. You have to pay about 3 months worth of taxes, but that's with any loan. Now, in a market where it's more of a buyer's market, let's say, what we used to do is get the sellers or have the realtor negotiate with the sellers, pay all your closing costs. And that's still possible. Just depends on how, quote unquote, hot the property is. So the seller is allowed to pay really all your closing costs. So it's possible that you could get into a mortgage with or a house with truly no money out of pocket. But there are some things to remember. I see a lot of people saying that you can get a USDA loan down to a 500 credit score. It's just not true. The reality is all mortgages, whether they be USDA, conventional FHA, et cetera, are going to be run through an automated underwriting engine. And the one for USDA loans is called GUS. And it is strictly for USDA loans. So anytime this is done, we upload your credit report, your income, everything about you, your bank account, your assets, and run it through the system, and it basically says yes or no. Now, you really need a 640 credit score to really have a chance at doing this. The reason I say this is that it's just not very forgiving. Actually, I've noticed over the last few years, the USDA loans are stricter than they even used to be. So if you don't have a 640 credit score, it's probably not going to work. But if you do, it very well may. The pieces that you need to pay attention to with the USDA loan is there is a income limit for the household. So when you apply for a USDA loan, you're going to have to give your really last 3 years of tax returns. And you're going to have to show everybody in the house, even if they're not on the mortgage, what they're making. Now, you have to go to the USDA website, or that's what we do. You can do it too. And I'll just show you here. I'm going to flip the screen over to show you what that looks like. So you go to the USDA, you actually just type into Google USDA income eligibility, and it'll bring it up. Now you click on there, and then you're going to go to, this section, and you're going to put in an address, and you can search, and it's going to say very clearly on the map whether that property is eligible for USDA loan or not. And the map for USDA loans is not like a map of the states. I mean, you could have one property on one side of the street, another property on another side of the street, and one is okay and one is not for USDA loan. So that's the first thing. Then you're going to go and you're going to look at income eligibility. And you can go in, you have to put in the monthly income for the borrower. And there'll be another field for whether you have childcare expenses. That will, if they're claimed on your tax return, you put them in there. Then you have to put in all other income from other people that live in the home. And you'll get to a result and it'll say, so in North Carolina, for Iredell County, it's a little over $110,000 for the household. It shows whether you qualify. So the next thing that you have to keep in mind is debt to income ratio. So debt to income ratio is very simply the percentage of your monthly debt, including this new mortgage payment, in comparison to your monthly income before taxes. Now, USDA debt to income ratio limits are quite a bit lower than other mortgage types, even conventional, definitely lower than FHA. So the housing part, so the amount that can go towards your mortgage payment, can only be 29% of your monthly before tax income. And it's going to be a little different as far as credit score, but typically it's going to be 29, and then the back end ratio, which is the household mortgage payment plus all other debts that appear on your credit report, can only be 41% of your household income. If you have over a 680 credit score, for example, the underwriting engine might approve of 43%, but that's really about it. So it's with an interest rate where they are now, this is being recorded in November of 2023, 7% interest, you might not qualify for as much home as you would have at a lower interest rate. But if you do, it's a fantastic loan. Now, of course, it's not necessarily in a rural area. You'll find there are homes in some neighborhoods that are still eligible in the USDA map. So I would encourage you to, if there's a house you're interested in, look it up on the map, see if it fits. Now, a few other things to keep in mind is you're not allowed to have 20% in the bank down. So if you're, for easy math, if you're buying a $100,000 house and you have $20,000 in the bank, you won't qualify for the loan, because it's really to encourage home ownership in rural parts of America. And if you have the means to put 20% down, then you're not eligible. So that's something to definitely keep in mind. But otherwise, it could be a really good loan. Another thing, definitely to keep in mind, again, is it is household income. So if you have, say, a boyfriend and a girlfriend living together, it's still a household. In underwriting, maybe only the boyfriend is on the loan, but sometimes I've noticed in underwriting, let's say there's a large deposit into the boyfriend's bank account, and then the underwriter is going to say, where did that $2,000 come from? And if you say in your letter of explanation, well, that was from my girlfriend, they're going to say, well, now we need to see her tax returns, and now her income might push you over the line and you wouldn't qualify. So these are just some things to keep in mind. If you have any questions about a USDA loan, feel free to reach out. My website is mortgagesbyscott.com. Feel free to put your comments and questions in the comment section below. And if you like this video, if you found it helpful, it would really help me a lot if you would click like and subscribe, and then you'll be notified of the next video that comes out. So thanks for watching.